G'day folks, welcome back to another update for the S&P500 and the NASDAQ. Now the charts, we had a bit of a drop as per the video we did around the weekend, but the prices or the charts have bounced since then. So are we still in a bullish momentum? We'll go to the charts in a moment. Always hit that like and subscribe button to support the channel, that'd be greatly appreciated. And always reference the +1 videos where we look at do a deeper dive into some of the trading strategies that we cover. In terms of the outlook as of mid-October, the S&P500 and NASDAQ hover near record highs, up roughly 13% and 17% year-to-date respectively. Markets remain buoyed by strong earnings, AI-driven tech enthusiasm and expectations of a dovish Federal Reserve. However, valuations are stretched with gains concentrated in a handful of large tech names. Rising US-China trade frictions and potential export restrictions threaten sentiment, prompting analysts to warn of a 10% correction risk if tensions intensify. Overall momentum is positive but increasingly fragile and amid geopolitical uncertainty. So looking at the S&P 500 first, look at the weekly here and you can see there the price is still very bullish, although we notice we've got a bearish divergence on the CCI1500. Now, again, we've had a bearish candle end of last week when we had a massive drop, and in the meantime we've had a bit of a recovery, but notice the CCI, apart from being a bearish divergence, the CCI is also broken into that moving average range. So still bullish on the price chart, but somewhat neutral on the CCI. Back previous weeks, you can see there it was hovering above the moving average band, which was consistent with taking long positions if you're trading on the daily. On the daily chart, it's hit this resistance up here at 67.52 before that massive drop we had at the end of last week. Notice what it did as well. The CCI broke below the moving average band, a very narrow moving average band nonetheless, and still somewhat below that band, giving us a bearish momentum. So ideally you want to start going short when both the price and the CCI are below the moving averages. At the moment, the price is neutral, so I would avoid taking any long or short trades until this decided where it wanted to go. It looks like the CCIs are probably going to drop. Alternatively, you might see it rise, in which case we'll see the price rise and most likely challenge that resistance up there. Now on the 1 hour chart, we've got, looking backwards, we'll see if there's any divergence, and that CCI, that black line, is moving in line with the price in terms of highs and lows and peaks. And back here, the last divergence we had was this period back here. We had lower peaks or highs on the CCI versus higher peaks or highs on the price chart. We drew a target range there, 23-38% range, and it fell right through. And that would have been drawn back to that Fibonacci range there. So the way we draw that 23%, that would have been actually on this one back here. Let me just delete that. Yeah, that was that, just a bit off. That was the initial divergence we had to that peak there. And then we extended divergence, let me just do it from here to that point, in which case there was another target range, the 23-38% range. So that also hit it there once, bounced, and then it finally broke very strongly to the downside. And since then there's been no other divergence on the hourly, and we always look at the hourly. Even if you're trading on the daily, we look at the hourly for any micro moves. Now looking at the back test, we've started it going long back here from around about the 23rd of April based on the daily. So you would have taken long positions back there, and if you follow my videos you know that I do say follow the daily trend, and at the very latest get out of the trade whenever you see the moving average on a CCI being penetrated by the CCI, as it did there. So you would have got out the first time in that little period there, and then let it go long again once it breaks outside on the price and the CCI is above the moving averages. Now this is a bit of a tricky area here because you're seeing that bearish divergence, but as long as the price is above that moving average band, and also notice, I didn't mention on the daily, but also notice the moving average band is still somewhat, the red and the blue moving averages of the band are still separated. There's a bit of a constriction there, and back to this period they're all pretty much in a bit of a constriction there as well. So what I'm looking for is any break below the moving average band, but also the moving average band potentially reversing. It broke below there, but notice a bit of constriction, but the moving average band kept rising. Now this could still rise, as I said, on the daily, but at the moment, as long as it breaks below and the CCI breaks below, we take short trades. Now, at the moment, you would have taken long trades based on all that period. And the reason I'm zooming out here deliberately, I want you to be able to see the peaks on the CCI versus the price. You can see there very clearly that we've got a bearish divergence there, and you would have closed out after each of those bearish divergence were made apparent. Another bearish divergence there. You would have got out of that one when the moving averages started bending down, and that would have avoided you getting into that drawdown. Again, another bearish divergence, getting out of that trade there, wait for it to recover, go long, and another bearish divergence, let it go. You might have got out there or just let it run. Sometimes you need to give it time to breathe to allow the average down process to work. And then at the very latest, you would have got out at that point there. We had a massive moving average turn down on that point there. And that was also showing us a bearish divergence at that point. Then going back long again when the CCI and the price are long, and again getting out of it there and avoiding that drawdown. Going long, getting out of it there, avoiding that drawdown, going long, getting out there, going long again until this point here, as I said, based on the daily. Now that's the daily back test, generated quite nice returns. Let's now jump to the short positioning. And that short positioning there starts from this period here on the daily, on that bearish candle. You can see there, if you're following this on the hourly, you would have noticed there the price broke below the moving average band, and so did the CCI, and that would have been your first indication of a potential bearish momentum, and that depended on where this massive line was. It still would have been above the moving average band, but you would have followed that, and you could have traded this on its own, but in this case it went quite strongly to the downside, and if you did catch that trade, you would have got out of the trade when that CCI broke into the moving average band on that candle there, so you would have made a nice little return there. And since then, avoid going long because you're still going short according to the daily, and then going short again there. You can see there the CCI broke into the moving average band, and you would have got out on that candle, made a few pips on that one. Avoid going long, and then more recently entered another position there to go short, and this one is hugging that moving average band, and you would have closed it out there. That would have been possibly a break even or a small loss if you would have closed it out there. So here we have the NASDAQ. So first off on the weekly, again the price is well above the moving average band, giving us a bullish momentum. Although notice we've got a lower peaks on the CCI, giving us a bearish divergence. So again, that's still somewhat bullish with the CCI above the moving average band. So bullish momentum, but just pay attention to that divergence. On the daily, and that's risen slightly since our last update. I'm just going to move that resistance. And what that also means is we've got just to stretch that bearish divergence. Now that's pretty much a double top on the CCI, but I can still consider that a bearish divergence versus the price movement. And again, that fell off. Now that was starting back from that period when that divergence started. And to take back the Fibonacci going from that high to that low, you'd be looking at a retrace to that 23-38% range, assuming it keeps falling from there. Now at the moment, on the daily, let's get rid of that, clean it up a bit. On the daily, you can see there the price is broken below the moving average band, but a very tight constriction on the moving average band and currently above it, whereas the CCI is just touching that moving average band below. This could go either way. Could go either start going long or short. So just if I was to be conservative about trading this, I'd probably stay away until it made a more decisive move. But very likely we might see a break to the downside. So at the moment on the daily, I'd call it neutral and avoid it trading if you want to just be extra cautious. On the hourly, again, the first thing we look for is any divergence, and that CCI seems to be moving in line with the price right up until probably this period back there. That was declining highs on the CCI versus slightly higher highs on the price, and that was a massive move. Now you would have been very quick to get in on that, but again, I don't trade these divergence. I look at them as areas to get out of the trade if I'm going long. But again, having caught that, if you had caught that, you might have done well, but again, that would have been more luck than anything. You had a bearish divergence back here, broke down here to the target, and then it's bounced out of there, moving higher. Now on the back test, again showing you the long positions first here on the daily, going long from there, Again, noticing most of that period you would have been going long with the moving average band still separated from the blue and the red lines. You had a slight constriction there. You might have, and I'll go show you in a back test to get out how to get out of that one. Then another constriction there, a false break. Then that actually started to turn down. That might have been a false break again. And then at the moment you're in another constriction at the moment, as I said. So again, going long during this period, and that's the long positions you would have taken from that period back there around about the 23rd or 4th of April. Again, notice, again, zooming out at this level, there's bearish divergence on each of these versus higher highs on the price. Another bearish divergence, so you would have got out of that trade at that point there. Another bearish divergence. In other words, just let it ride. As long as the daily is moving in your favor, let the trade ride and average down or close it out whenever you see a moving average band turning down after a divergence. So you've got to give it time to breathe sometimes. So you would have got out of that trade on that point. Going long, get out, going long. Another bearish, longer term bearish divergence here. Sometimes if you zoom out, that's why I don't like zooming in too much, because sometimes you get a bit confused with the various. There are smaller divergences obviously throughout the whole period, but again, if you want to sort of stand back on if you're trading on the hourly in this case, you can actually do that. Stand back and watch from a distance and see how it performs. Now you'll notice here, just jumping forward to this period, again, notice you would have got out whenever you see the moving average band turn down. This was a massive drawdown. So if you had been caught averaging down during that period, that would have been going from about your account from about 137,000, assuming you started with 100,000, and I'm not suggesting you do that. And it would have drawn down to almost zero and below had you kept in that trade. But again, notice here, getting out of the trade, once you see a bearish divergence, you would have got out at the very latest near the start of that period there. And you might have held a contract or two open, but you would have avoided that massive drawdown. Again, you would have probably gone long during that little period within that range. The profitability rose. Close it out at that point, going long again at that point there. And that would have done quite nicely since then. Closing it out there, going long again there. So you can see there the pink and the green lines in that moving average band, but again, paying attention to any bearish divergence. Make sure you hit that like and subscribe button to support the channel. It'd be greatly appreciated. And for added benefits, if you want to get some weekly bullish share ideas, want to subscribe to the Patreon page. And that's where we do monitor some stocks we do actually cover in the videos. And these are some of the trades we've made recently, which is showing the results of those trades. So thanks again for watching, and see you in the next update.